Welcome back to the channel. My name's Cody. Today I'm joined by Hershey. So if you haven't already, please hit the subscribe button. Today I'm going to be talking about 3 metrics that you should map out in your business to make sure you don't go bust. Number 1 is called your cash burn. Everybody likes to talk about cash flow, but realistically in a business, you're going to have a period of time where cash flow is actually negative. You're burning cash every month. Could be in any company, any business, any industry, where you're actually spending more money than you're bringing in. You need to map out what's your actual cash burn. Some people like to say, oh, I think I'm doing okay. I've got a lot of revenue. Revenue doesn't matter. Cash flow matters. So map out wherever you're at in your business, what's your actual cash burn out right now? An example of this, one of my properties right now, we're doing a massive renovation. It's a big flip. When you're flipping properties or flipping a company, there's going to be periods of time where you're not actually making profit. So I'm looking at, okay, we've got $100,000 in a bank account. If the cash burn is $10,000 a month, I'm not going to make it a year without another cash injection. So I need to either figure out, can I liquidate that asset, or do I need to add more money from another part of the business? And so you got to map out your cash burn so you know realistic timelines for you to either fix, flip, or get new cash in from somewhere else so you don't go bust. Next thing you should map out is your obligation timelines. If you know you've got an obligation you've got to hit, and let's say you've got to come up with $150,000 in the next 18 months, you get to do an analysis and say, given my current production, this is the third piece, the production analysis, do I have enough on the table right now to clear my obligation? And how much money would I have to make to do that? If you have a $150,000 obligation in the next 18 months, you divide it out on a monthly basis and figure out how much do I have to allocate towards that specific liability. And realistically in your business, it's not going to be a monthly save. You're going to have a couple big hits along the way of cash injections or opportunities to reduce that liability. And that production analysis, which is the third piece here, is really looking at all the pieces you have on the board. Do you have enough going on to clear everything that you need to clear? All your liabilities, your cash burn to get it actually cash flow? And the answer might be no. One of my big obligations right now is tied to the hospitality business. I've got $1 million investor that I need to pay off in the next 18 months. And so I have to look at my pieces and say, do I have enough production capacity within what I've already built in the business to clear that? And the answer about 6 months ago was no. So I went out and bought an RV park flip. We bought a motel conversion. And we're looking at, what do we need to add to the universe to be able to clear all the obligations in the obligation timeline, and that we can schedule it all out. And again, it's not a monthly save. We are planning on getting a few big cash injections because we added pieces to the board, because we did this analysis and said there's not enough in front of us to clear our obligations. So we need to go more pieces. Got to go get those pieces, add it to the board, optimize them, liquidate them, take the couple big cash hits. We'll get about 3 of them, given our current business. That'll be more than enough to pay the taxes and pay off the investor. But it's only because we did this analysis. We looked at our cash burn, and we looked at, okay, what's our timeline for these obligations? And we did a production analysis to see, do we have enough going on to clear these obligations? The answer was no, so we got more stuff involved. Once we're through the obligation, we're going to simplify everything again. Go back to being super simple. More is not always better. And so we won't need to go add more pieces to hit our existing goals. But this is something that every business should be doing. You should be doing it for your business, because it will clarify everything that you're working on, and simplicity is what allows you to repeat the actions in your business. If it's super complicated, it's hard to repeat, then it's not worth anything. With that, this is the end of the video, but please hit the subscribe button. If you liked it, hit the like button, and I'll see everybody next Tuesday. If you have any thoughts, put them down below in the comment section, and have a great weekend.